About what Martin Crabb from Shaw & Partners has been watching us, hopefully too, live from our Barangaroo studios. Martin, good to see you.
Good to see you, Nadine.
Okay, so geopolitics is where our morning stand-up started today. You know, we've got these rising tensions with China taking aim officially, really, at coal.
Yeah.
How are you guys talking about it in the office?
Yeah, it's difficult to know what's motivating this. It does seem to be creeping into different commodities all the time. The big concern is iron ore. You know, we sell about 60% of the iron ore that China imports, which is going to be 1.1 billion tonnes this year. So we don't think they can have a go at iron ore because there's just no other place to find it. But that remains a massive uncertainty. Imagine what our currency would do and our share market would do if they did in some way curtail imports from Australia. So that's really the fear. They just seem to be picking them off one by one. The coal sector has been on a tear this year because obviously the prices recovered, but Aussie coal prices have stayed low, and everyone's saying, well, they've got to get back to where they are, you know, $200 a tonne, not $100 a tonne. So we've seen 60 or 70% moves higher in some of these coal names. We've got it belted today. Coronado's down 15%, Whitehaven's down 5%, Yancoal's down 10%, I think. So most of the pure coal names have been really knocked around today. We're still fans of coal. I think if you asked our research team and our dealing desk what's their favourite commodity for next year, it's either coal or uranium. You know you're in a bull market when people are talking about uranium.
Yeah. It's come up a lot lately.
Yeah, so those two, you know, people are picking their stock of the year. It's typically, you know, Atrum Coal or Paladin Energy or one of those sorts of names. So we're still believers, but obviously there's a little bit of a speed bump in the short term.
You touched upon iron ore. We had the China Iron and Steel Association out yesterday having a bit of a whinge about how much the input costs were for the raw ingredients for its steel producers, of which, of course, iron ore is a major factor behind that.
Yeah.
I also saw another chart today. The iron ore price, the spot price against marginal cost production, 130% above for the marginal cost by far.
Yeah.
So you put all these things together and anecdotally kind of points to a really overvalued price. Now, we know there's a lot of fundamental factors, but surely the bright times have already been seen, or we're seeing them right now.
You'd think so. I mean, the flip side to that is the steel makers themselves are making pretty good money at the moment. I mean, they can afford to pay $160 a tonne for iron ore and still make good money. So they're doing very well. And obviously China's producing records amounts of steel, and obviously they've pump primed their economy as a way to get out of the coronavirus. So they're driving the price higher. It's not manipulation on the part of Australia to get the price up. Everyone's going flat out, right? So we do have supply tightness around with Vale failing to meet its production targets. We do have some weather impacts off Port Hedland, which is restricting port activity there. So there are some phenomena well outside the control of any of the iron ore producers. And as I said, everyone, if people could sell more tonnes right now, they'd be doing it. So it's very much demand driven, and we don't know how much, Scuddy, speculative activity there is in the iron ore market. I put out a chart on Friday which overlaid Bitcoin with iron ore, and the correlation's pretty high.
Yep.
It's pretty high. So there's speculative activity in particularly the Dalian futures market, Chinese speculation. So that might be more to do with the price strength than anything that the Aussie ore miners are doing.
Yeah, some of the other price moves in Dalian iron ore futures on Friday were chaotic. There was no other way to describe it. It went from limit up to limit down in the space of a couple of hours.
It's real casino stuff, isn't
Absolutely.
it?
But we did have data from China.
Yeah.
Speaking of
Good
industrial
today.
production, investment, retail sales, all looking pretty solid.
Yeah. So industrial production running at 7. I think retail sales running at 5. Very much in line with expectation, but you know it's pretty amazing that they can pump out those sorts of numbers in that size economy. So yeah, it just looks like they've got their foot flat to the floor. There's no reason why governments and central banks aren't going as hard as they can at the moment. They've got this, you know, this pair of very high unemployment and very low inflation. And so they've got, you know, basically a one-way ticket to go as hard as they can. So China's starting to restrict a few things here and there. They're starting to put some quotas on a few industries. They think the economy's probably running a little bit too hot in some areas, but every other country is just going as hard as they can.
We know the infrastructure story is a big one when it comes to the bullish thesis for China. I've seen a couple of analysts out there who've been talking about potentially that maybe the top has already been put in there. I know that I'm pretty optimistic about what China looks like. Do you think that maybe collectively as a group of people we're actually maybe got too many eggs in the one basket when it comes to that outlook?
Yeah, I mean, for Australia it's a big risk. It's 40% of our exports, right? So if you're a company and one customer was 40% of your sales, you'd be, you know, the share market would give you a bit of a risk rating for that, right? So if it wasn't for coronavirus, China would have already pivoted away from the infrastructure side, the building. They don't want to do that. They want to evolve more of a knowledge economy. They want to dominate, artificial intelligence. They want to dominate, sort of high tech. They don't want to be just putting up more office blocks and residential blocks. So, but that's, when the coronavirus hit, they just went back to mama again. They went back to what they know, which is, just building more stuff. So I think they do want to pivot away. And one of the real issues there is their environment. So coronavirus has had, perversely, a very positive impact on the climate, because we're just not travelling and burning fossil fuels the same way we are. So it's given countries like China and India a little bit of breathing space to do something about it. But I think they would like to pivot more towards tertiary industry, but they're pretty much still stuck in that manufacturing area.
I'm curious, we had a chat with Mary Manning, who is a fund manager, portfolio manager at Ellerston Capital earlier on, and talking about exposure to Asia. She's obviously quite positive still. She's that's her wheelhouse. Do you at Shaw & Partners look at a way to leverage off that China narrative only through Australian companies, or do you look to some Asian ETFs, for example?
Yeah, there's some of our advisors would actually go and buy direct securities, so we can certainly do that through our custodian. So things like Tencent, Alibaba, those stocks feature quite prominently in portfolios, just because they give you exposure to China, but also to technology within China. So that's one route. ETFs are also very popular for those advisors who don't want to spend the time reading the research and understanding the names. They'll just go and buy a broad one. So one that's popular again in that space is CNews. So again, it's China and technology, but I think it's the 50 largest technologies on Asian markets. So that's had a broader appeal. We tend to use them for asset allocation. So right now we're saying, look, we like the Aussie dollar. We think the Aussie dollar is going to continue to appreciate against the US dollar. We also like emerging markets. They'll probably come out of the coronavirus faster than some of the more developed. So can you buy a hedged emerging markets ETF? So it's very difficult to sort of find a stock that'll do that for you, but you can find a broad exposure. So our use of ETFs and hybrids and listed investment companies has just continued to rise, probably for the past decade.
I'm keen to get your views on IPO. Since we last spoke, we saw the DoorDash IPO, we saw Airbnb, huge gains on the day, amazing. We've also seen a whole raft of companies, I think 3 today went listed here.
I think it was 3 or 4. We spoke with 2 of them.
Yeah, Liberty Financial was one that went listed today. I can see its share price up close to 16%. What's your take about the activity that we're seeing IPO markets so close to Christmas? Yeah,
well, the door's been closed for the best part of the year, right? So hence the flurry of activity. I know fund managers are exhausted. Small cap managers are basically saying, look, we've had enough. We've just had too many deals. And we're actually saying no to deals, not because we don't like them. We just don't have the time or the energy to due diligence everything. So Liberty Financial was a good one. It was only a small percentage of the stock that was sold. I think the ownership group continues to hold about 77% of it, so it was only a small amount, but it was well priced, and also the timing was good in terms of the bank sector was ripping when they were doing the pricing. So you actually got it $6, it's trading at 7, so they left a bit in there. But it is sort of bull market stuff, Scotty. I think the final stage is M&A. We're just starting to see more of that too, but very frothy IPOs and IPOs that have come back the second or third time. Liberty, I think, has probably had a couple of goes at this. I think Airbnb also had a couple of goes at IPOing. So, it does feel a little bit frothy, but it's just a manifestation of how much liquidity there is in the system. There's $277 trillion worth of debt out there that's been raised. Not a lot of it's been spent. So there's lots of dry powder, there's lots of money on balance sheets, and people are just trying to find a way to put it to work, because you're not going to make any money in the bank, right?
Well, no, you're not making money in the banks, but maybe you can make money off the banks because, we heard from APRA today in terms of the dividend. We got hints of that from Westpac at the AGM last week, that they're looking to increase their dividend payouts, and then you've got the whole economic recovery story. We know the narratives. How are you looking banks as we head into 2021?
Yeah, I mean, they were a really good trade about 3 months ago. They weren't priced for a recovery or a vaccine. Everything else was, like everything except energy and banks was. So we hooked into the banks, and they just went berserk in November. I think NAB was up 30% in November. So I think that trade's gone. It's now, okay, where do they fit in the portfolio? So they're there to generate income. The dividend yields right now on consensus numbers, 3.2 for CBA, and then up towards 4 for ANZ, Westpac and NAB. and that's with this cap in place. Well, this is off 2021 earnings. So I just had a look at payout ratios that analysts are expecting. Everyone's expecting above 50 already. So I don't think today was massively news. The question is how quickly will they move back into the high 70s or even into the 80s, which is where they were. So if you're the CEO of a bank, you're sitting there, how much profit do I need to retain in the business to grow the balance sheet? And the answer is not a lot, because the balance sheets just aren't growing that strongly. Credit growth is not spectacular. It might be for next year because we'll get a bit of a pop, but into the long term, you're looking at nominal GDP for credit growth. There was a time when credit growth was running at 2 or 3 times GDP, and therefore banks needed to retain a lot of earnings to grow the balance sheet. Now they don't. So they'll be heading, those payout ratios will be heading back up towards 75. So I had a look at the numbers today. Dividend growth for next year we've got 3 to 4% yields. The following year we've got 25% dividend growth forecast for all the major banks, and then another 10 or 11 after that. So these dividend yields in 2 or 3 years' time will be 5, and they'll be fully franked. So you're looking at 6.5 yields when you've got bond yields at 1. So even if the growth story is not spectacular for the banking system, that's a pretty good yield. So I think that'll continue to play an important role in portfolios.
Good.
Martin, just to finish off, it's 10 days out from Christmas. We know that the retailers are probably doing a roaring trade at this time of year. What's your take on that sector? Because it really is one of those divisive ones at the moment. A lot of people have seen what's happened this year and going, well, boom times are back. But of course, longer term, there's still a lot of uncertainty about it. Where do you sit when it comes to that investment plan?
Yeah, I mean, I suppose I spent the last couple of months trying to pick the top, particularly the supermarkets, because you kind of go, right, there's a lot of pull forward demand, and once we get a vaccine and we open up, shopping will return to normal habits, and therefore there'll be a period of weakness. So the supermarkets might actually report negative same-store sales. I don't want to be owning them when that's happening because everything else will be ripping. But I've probably changed my view on that, just looking at the national accounts and looking at how much money's been saved and socked away. It's about 100 billion that's sitting in households. So Australian households have reduced debt during COVID. We're one of the only countries in the world where households have not taken on a lot of debt. Also, we've rated super, which is one of the more stupid policy decisions of the current government, if you ask me. We've rated 40 billion out of super, so that's also sitting there waiting to be spent. So there's this massive, I suppose, nest egg sitting there in bank accounts. It's not going to be invested, it's going to be spent on stuff. So I think, Christmas is going to be good, Easter's going to be good, winter's going to be good. It's just all of next year, you're going to see higher than expected retail sales. So we're just going to stay long the supermarkets and stay long the retailers like Temple & Webster and Kogan and JB Hi-Fi and these stocks. We just think they're going to continue.
Well, I believe this is our last chat of the year.
It is.
Martin, thank you for everything this year. Thanks for your support, all of your insights. We
You're
really
most
appreciate
welcome.
it. And we look forward to 2021.
Same here. Thank you.
Martin Crabb there, CIO of Shaw & Partners.